Hello there. Now today on Dukascope TV we're going to be talking about the corresponding links between the shipping market and the demand for raw commodities. Who better to join us for the discussion than Richard Watts from HR-Maritime. Richard, thank you so much for coming in today. Now if we look at these two markets, shipping and commodities, we hear a lot about them certainly, but could you just begin by briefly outlining what the two are?
Well, first of all, if we look at commodity markets, it's important to understand that we are talking about a huge market. Now, we can't talk about commodity markets as one whole market because it doesn't make an awful lot of sense. And so it's important to split it up into the different markets that are involved. We have dry commodities, we have grain, we have metals, we have all the different ores. I believe the latest figures of UNCTAD quoted $18 trillion worth of commodities traded on a yearly basis. Wow. And so it's very important to look at different sectors as they're important to us and not try to look at it as an overall thing. Okay, so that's the extensive and heavily traded commodities. Tell us a little bit about the shipping market, please, Richard. Well, the shipping market is just as vast as the commodity market. When we're talking about the shipping market, we're talking about a huge range in the size of vessels that we're talking about. First of all, we have ultra-large crude carriers, which might be carrying up to 500,000 tonnes of oil. We might be talking about small coastal vessels, which are carrying 100 tonnes. There are the new valet vessels, which are carrying 400,000 tonnes of iron ore, which 10 years ago would have just been completely unbelievable. And so it's important to define what area of the market we're actually looking at for it to make sense. And also because we're talking about a global market, things can change very, very quickly in different parts of the world. And so a shift in demand in one part of the world can have a corresponding effect on different markets of shipping, and that's why it's important to understand the whole range. Okay, so you mentioned some shifts there and how they're all correlated between the two separate markets, but we've seen some quite significant changes in commodity prices over maybe the last 10 years. What sort of impact has this had on the shipping market in your experience? Well, when we're discussing the shipping markets, we're really talking about the cost of shipping goods. The main indicator for shipping rates is the Baltic Dry Index. If we look at the actual Baltic Index itself, here we have, first of all, this is the rates for the last week. On the top we have the very largest vessels in green. Those are the vessels which are Capesize, which have to go around the Cape of Good Hope. They cannot go through the Suez Canal. In light pink we have the Panamax vessels. Those are vessels which must transit, that can go through the Panama Canal, and so under 70,000 tonnes. And at the bottom we have dark pink, and those are called Handymax vessels, and those are effectively general cargo vessels which can do any type of cargo, and they are the smaller vessels. If we look at it over a week's period, there doesn't seem to be much fluctuation. No, it's quite steady, isn't it? However, as soon as we look at it over the last 6-month period, we can see that there's been quite a bit more fluctuation. Certainly in the large vessels, we can see that it goes up and down quite a lot. The main reason for this is because it's a much smaller market. There are in the region of maybe 700 vessels in the Cape-size market, and so any changes in the demand for those vessels will obviously have a corresponding effect on the rates themselves. If we were to have a look at the rates over the last year, we can see that in fact it starts fluctuating quite a lot. And so the Cape-size rates, while this is an index, so it doesn't tell us the actual rates themselves, it's going from around 1,000 up to 2,500, and that's quite a large fluctuation. If we take then the last 3 years, which is quite interesting because we've been seeing the differences in the financial markets and the commodity markets over that time, we can see that there has been significant fluctuations. The larger vessels, they carry iron ore, they carry coal, they carry wheat, and so as there's changes in demand for these commodities, then it changes the demand and the rates for those vessels. Whereas the smaller vessels are very flexible, they can carry nearly anything, and so the rates tend to stay much more stable. If we were to look a little bit further back and we go for the last 5 years, that takes us from 2008 up to today, and we can see immediately the crash of 2008. Yes, it's quite apparent down there, isn't it? And we can see rates that went from 14,000 down to about 700. What this represents is a daily rate of the vessels in mid-2008 of about $200,000 per day for a Cape-size vessel, a 150,000 tonne vessel, down to rates of about $15,000 per day. And so it's significant changes. But if we look at it over a significant amount of time, and we look at it over the last 10 years, for example, from 2003 onwards, we can see that the market is actually rather cyclical, and the crash in 2008 was mainly due to the fact that the rates went up way too high.
That is very interesting, because I was just about to say it looks as though we haven't really recovered yet, but when you take it into a broader context, it does seem as though we're getting back to perhaps normal levels of supply demand. Fantastic. Now, one other thing that we were going to discuss about is the impact that these correlations have on building new vessels. Could you tell us a little bit more about that, please?
Well, as you can imagine, when the freight rates are very high, then a lot of the ship owners, they want to take advantage of these high freight rates, and so then they start building new vessels. They order new vessels to be built. The problem is that it takes on average about 3-4 years to build a new vessel. And so the calculation that they made in 2008, when the freight rates were very high, was very simple. They looked at the rates that they were earning on their present vessels, and so how much money they were going to be receiving in the future. They also looked at the ability to borrow money from banks, because nearly every vessel is bought with finance from banks. Then they looked at the amount of money they were going to be making from the new built vessels. And when you look at all these things together, it made perfect sense to build new vessels. And so there was a huge boom in new building. And we even saw in areas of China where they would take on orders for new built vessels without even having a shipyard in existence yet. And then as they got the order, then they would start building from there. The problem is that after the crash, these three factors suddenly turned on their head. And so the amount they were earning on their present vessels plummeted, the appetite for lending from the banks plummeted, and the amount of the money they were going to earn on their new vessels they were building was also going to plummet. Now, I think we would have seen more ship owners going out of business if the banks hadn't tried so hard to keep them going. Because the last time we saw a similar crash in the shipping markets, back in the 1970s, one of the largest ship owners in the world was BNP, the bank, because they'd repossessed so many of the vessels that they had financed. And they were desperate not to fall into the same situation. And so now we see, because the banks have extended some of these loans, we find that the rates in the shipping market, instead of taking the hurt immediately and then coming out of it quite quickly, it has ended up being quite extended. And 5 years after the crash, we're still seeing very, very depressed rates. We're seeing way too many vessels available on the market, and we're seeing slowly more vessels being scrapped, but they're being replaced so quickly by new built vessels that the supply of vessels is not going down significantly. And so while it seems that the rates are very depressed now, the rates that we're seeing today, they are very low compared to the rates that we were seeing in 2008, but they're not particularly different from the rates that we were seeing in the early 2000s. And so we can see that the market for shipping is highly cyclical, and it will go around again, and at some point in the near future the rates will go up again, people will invest in new vessels again, the market will crash again, and we'll see the rates come back down again.
Well, it does seem as though all these factors you mentioned culminated to create the perfect storm, but hopefully we can weather it for the next cycle. Richard, thank you so much for coming in and discussing it through with us today.
Thank you.
Well, that's all from Richard and myself. Next week he'll be back in the studio to talk about the changing face of trading companies, so please do click back for that. Goodbye for now.